Hello, my name is Doug Lennick. Welcome to Smart Money Moves. I'm here with Adam Recker, our Senior Director of Equities. Markets move, so do emotions. We're talking about today, and even before we get going, Adam, the markets are going to do something, right? With the Fed, what'd the Fed do? Let's talk about the Fed. Let's talk that. Did something happen today?
Yeah, as we were kind of discussing a little bit, but prior to this, it's good proof that this is truly live, given live data is feeding in. And so, as expected, the Fed cut rates again today by a quarter point. There's general agreement with the move, and a lot of this was expected ahead of time. There was some dissent. Governor, I guess Murin in particular, wanted a more substantial 50 basis point cut. Another governor wanted to hold, but all things considered, it was really aligned with expectations at this point. And so, given expectations were really set, there really wasn't much movement in the market to speak. I think actually ended up basically flat on the day, looking at something like the S&P 500. And so,
Well, it kind of did what it did, and it's been doing it. If we look at the next slide, I love this picture that we got this big bull, and then the market's been keeping going. It's been on the run here, and sometimes that's happening even when confidence is low. All these things don't always sync up quite the same. Why does that happen?
yeah, I think there's a very long answer potentially to that, but for the sake
Well,
of
we got
time,
28 minutes left, so then that's it.
maybe longer than that. But a couple things to keep in mind. For one, not everybody interprets data the same way, so we'll spell this out a little bit more as we go through. But again, people can interpret data through whatever their worldview is. Another thing is often, as we'll show, people get anchored to what's happened recently and extrapolate into the future. Even things like recessions, they aren't announced until really after the fact. And often when a recession is announced, recoveries may be already taking place. And so, um,
Well, and this is, as you see the slide that just pops, we got what we're seeing now, the notable absence. We don't see the Dow here, but what's going on now?
yeah. So giving kind of just a general state of the economy and update on what's been going on. And I'll share the Dow for those that are watching. We've replaced that more or less with the S&P 500, very similar. Not as long running necessarily as the Dow, but maybe a better representation of the economy today. And again, the update isn't terribly different from what we saw over the past quarter or since we've last met, even. Um, Overall, world markets have been strong. International has done really, really well for a number of reasons. A lot of it has to do with one, cheaper valuations overseas. Currency effects are a big part. So the weakening dollar from a very strong position over the past decade plus has been a nice boost. And just again, overall improvement from an earnings perspective. That being said, the U.S. has done really, really well again this year. A lot of it driven by tech and AI related developments, and so that's worth keeping an eye on. But as we'll show really in the next slide, um, more recent terms, again, looking at previous Fed rate cuts have had an impact. That being said, the impact was anticipated well ahead of time. And so as market participants were, let's say, preparing for a potential rate cut, because the markets try to be forward looking, we started to see things like small caps perform better. And so previously, if we go back a quarter or so, they weren't performing all that well, but really have shown some signs of life given the lower rates should be less burdensome on those smaller cap companies. And so we saw some nice performance in the past quarter, month, et cetera. On top of that, too, things like municipal bonds have done better. There were periods of weakness, especially over the past year. A lot of it had to do with not necessarily fundamental reasons for weakness, but really technical reasons where there was just an oversupply of bonds in the market. The demand didn't quite keep up with it. Now, some of that, let's call it quote unquote, excess has been worked through. And so we've seen better performance out of that segment of the market.
Now,
So
will we also, Adam, see, as you talk about interest rates, oftentimes there's a inverse relationship between the value of the bond itself
yep.
and the rates. So as the rates drop, older bonds are worth a little bit more. Is that holding true now?
To an extent, yeah. So, and I think this is a callback to the previous session or our previous webinar, but it's not necessarily an impact across the board. So the Fed directly influenced the shorter term rates. There
Yeah.
is a clear connection there where as they cut, we would expect savings on money market funds, CDs, things like that to be set lower in due course, which is a good argument for locking in some of those rates to benefit from those cuts on the shorter end. The harder part is the longer end, more of the intermediate to long-term bond segment. That isn't directly influenced by the Fed alone. There's other dynamics that come into play, but generally speaking, cuts and lower interest rates end up being better for price appreciation in bonds.
Yeah, and something else you said earlier, I caught my attention when you were talking about the equities that have been, are driving up. We have AI and tech, and this is just Doug Lennox knows nothing about the AI or tech as an investor, other than I think about this. I wonder, are those stocks in the tech world, in the fintech space, are they being rewarded for speed to market now? And how does that impact, like the quality of the artificial intelligence? Does that sound like a fun question for an equity guy?
It's a fun question. It's a difficult question, and I'm
Oh,
not sure I have the great answer for it at this time.
yeah,
But you can definitely see these stocks being rewarded for announcements at least, and
yeah,
getting things out there, whether or not they're terribly impactful. And that's again probably a conversation for another day. But
yeah.
the market is
Well,
acting like this is going to be transformative, and I think it will clearly have an effect. But the jury's out on how
well,
transformative.
and I think both things can be true as we think about the behavioral element here, because we're talking about markets and we're talking about human behavior, and all of these things can be true at the same time. I mean, it can be true that it's going to change everything, and it is. That's definitely true. But on the short side, it also can be true that somebody could make a decision to do something based on a short-term announcement. Both things can be true. And so we should be sensitive to that as investors and just be aware of it. But the long-term game, I think, is absolutely, this is a game changer.
Yeah, I
Uh,
think it's about risk management and figuring out time horizons. I think what the old adage is you kind of underestimate what can be done in the long run, but you overestimate what's going to be done in the short run. Even something like the internet that clearly was transformative with the benefit of hindsight, that had excessive run ups and downturns, doesn't change the fact though it became transformative in the end. And
well,
so yeah,
that's right. Well, in fact, and this will date me. This is puts me a lot older than you, but I remember when Alan Greenspan was chairman of the Federal Reserve and he talked about irrational exuberance. This is in the late 1990s. Some of our viewers will probably remember this as well. And in fact, that was the dot-com world, and companies were going way up in valuation in spite of relatively low earnings. And it was irrational exuberance, but it was also true that the game had changed. And so even the people who bought irrationally at that time, if they held on, today they're fine. That's what we're talking about. The long term is one thing and the short term is another. And what we are doing here at the Mather Group for our clients is we're playing the long term game in a way that they're ready for anything that happens on the short term, which I,
yep.
I find to be a terrific thing for our clients. So I'm positive on that. So I like this. Thank you for sharing that. What do we got next?
So
Oh,
Yeah, I was going to say this maybe kind of touches back on the interpretation of the data. So you can have things that are going on in the market. We all agree that they're going on in the market. We just may feel differently about them and have different takeaways based on what our prior beliefs, hold. And so the confidence versus caution part, you could have again a data point, and you may react in a way that leans one way or the other. And so, even speaking to today and the past Fed announcement, there can be a Fed cut, the anticipation of a cut. In some ways, that may be viewed as a positive, providing relief to people that have uh, debt loads, or just sort of the reaction that in the past cuts have generally been positive for the market. And so you get sort of a reactionary response that I see cuts, it's likely going to be good, and people respond to that. Same token, there's also people out there saying, well, those cuts could lead to higher inflation. I need to be more risk adverse. Also could be true in the end. Or looking at things again like the S&P 500. It's done well this year, maybe not as well as foreign markets. And so some may see that dynamic and say, well, foreign outperformance is maybe a flash in the pan. I'm not ready to lean that way just yet. And the S&P 500 has been strong the last 15 years, and that kind of outweighs everything. I would still rather stay heavier US. At the same time, people recognize that markets are generally getting expensive. It doesn't mean that there's going to be an imminent downturn, but there are growing concerns around valuations depending on who you talk to. And then again, our experiences really inform how we behave in a lot of ways. And so, especially recent performance, there's a habit of extrapolating that into the near future and assuming that that's going to continue. And so, when we look at this, we have to acknowledge that people have their prior experiences. It's going to affect how they think about the world. We know these outcomes are going to end one way or another. You probably don't want to bet on just the status quo continuing forever. Um, and so our view is we acknowledge all of this, but why don't we find ways to kind of account for the possibility that both can happen, be prepared for both scenarios, and plan accordingly? So try to take more of a middle ground, not put all of our eggs in one basket, or take on overly excessive risks, or be overly conservative either, because that's probably not the right solution.
Well, and the thing too, and I think that's a really important point, Adam, and it's not that you're saying I'm going to put all of my money into a conservative investment or a moderate investment. What it says, what you're saying is I'm going to diversify and I'm going to be ready. If the market goes up, we're going to participate in that because we own some of that. But if the market goes down, we're fine. If you need money, there's going
Mhm.
to be a smart place to get it. And then we will be doing the rebalancing throughout. That's what the Mather Group will be doing for the client. So the client really doesn't have to do anything. They're prepared. So should our clients be following our advice, which we want to make comprehensive and preparing you for all that Adam just described. So although we don't know day to day, is the market going up today or down today? What we do know is it doesn't matter. If it goes up today, you are prepared for it with your portfolio with us. If it goes down today, you are prepared for that as well. And then the rebalancing that would take place within that portfolio will be done by us. So
Mhm.
you, the investor, don't actually have to do anything. So a lot of times people think the Fed just dropped its rates. What do I have to do? And what I'm hearing you say, Adam, is you're not required to do anything today.
Yeah. In fact, having a reactionary response is probably not the right choice. We want to plan ahead of time so we're not in a position where we're making emotional decisions.
Well, and that's why all of you are welcome to use this term in your banter at your next cocktail party. Tell them you have learned that it's better to e-think motion than it is to emotion. So what we want to do is pause before we mote. And when we do that and we think about it, we ask ourselves, have we are we prepared? And if we've done our jobs well, the answer to that question is yes. This other thing on anchoring, and I think people, I find myself doing this because I, in my own head, because I grew up, and your point is right. The Dow Jones matters a lot less than it used to, but it's something that a lot of us, older folks, uh, got anchored on it, and for many of us, I think many people kind of think the Dow first got to 25,000 in this real year 2025, and that's not true. The first time the Dow closed a day above 25,000, I believe, and you can tell me if I'm right, but I think it was in July of 2024. And so in my mind, I thought, well, everything below 25,000 isn't any good. And so for me, I was anchored on that. And then I finally got back to, okay, we're back to 25,000 and now we can start seeing some gains. But I'm not the only person who behaves like that and thinks like that. And I
Oh,
actually have learned how to mitigate against that because I've begun to understand my biases. And that's part of what is important to hear, as I think you've expressed.
yeah, absolutely.
Let's look at what's next and see where we can take our people here. This I find interesting. This speaks to one state, but I'm guessing you would see this as pretty consistent around the country.
Yeah, it's some of these additional charts here going pretty quickly through them just really talks about like sentiment and how are people feeling and how do we think about that. And so, and it's not to tell anybody how to feel, to be clear, but we need to account for it and interpret it. And so, what's interesting, and I think we touched on it in previous discussions, but never really quite showed it like this. Sentiment readings, they can be useful, but really it's taking a gauge of just how do people feel. And what we find increasingly is a lot of how people feel is really tied to political leanings, not saying anyone's right or wrong. But if you look at sort of the left hand where the red is a little bit higher than the blue, that's when President Trump was in office the first time. And then you see the blue go a bit higher. Those that lean more Democratic felt better about the environment, Republicans less so. And then as the next person takes control or is in power, you see that reverse again. And so one of the things that many economists are watching is, how much meaning does it really have given the sort of the undertones in the overall sentiment. And so just one point to kind of keep in mind. And it may also explain why do I feel the way I feel at this point in time, given what's going on in the market. Just things to reflect on.
Well,
Um,
our emotions often, obviously, which was what we're talking about, it's designed, the word emotions, you're designed to feel it, motion, get into motion. And it's real, and this is the biology here that's working. And Adam has said this a couple of times. I want to just, as a color analyst, I'll just add a little color here. And this gets into the behavior, human biology, if you will. If we think of our human reality as a combination of our cognitive thought, so I think of cognitive thought and then our emotions. So both our thoughts and our emotions are real and they are separate. They're not the same thing. We kind of get confused there. And then our physical self. So that's our reality. And what we've been talking about is things outside of us happening that stimulate our reality. So it's important that all of us know that when our reality is stimulated from outside of us, it stimulates us emotionally first. So I'll just use the Fed rate cut as an example. The Fed cut its rate by 0.25% today. That's what happened. We experience that emotionally first. It happens really fast, 12 milliseconds. And so with that emotion, sometimes people will actually make decisions. And so we need to understand, and this is what Adam is saying, the Fed rate cut was a quarter. The cut didn't change for Democrats or Republicans. It didn't change for people who are optimistic or people who are pessimistic. It's a fact. It's just a quarter. And what it did, though, is it made some people feel one way and some people feel another way. And that's what Adam is talking about. And we can't tell how each person is going to feel, but what we can know is that markets will move based on this. And that's why over time, investments often work better than investors, unless you have someone like we have here, luckily, Adam Recker, behind the scenes managing that for us. And that's the concept. I don't know if I said that in a way that made any sense, or did I sound quite confusing? What do you think?
I followed it. I think so.
We'll go
But I
with
think
it.
wavelengths. So
By
we're
the
good.
way, I should mention if there are questions, and I'm the failure on this, I just saw one come up,
Yep.
and so I'm going to go to it and see what it says here. I understand the strategy of long-term perspective, as noted by Doug. However, there are those of us who are longer in the tooth and confronted by a shorter runway. I love how you said that. Given potential for market volatility, which may result in a significant downturn in the short term, do we go into turtle mode? Example, pull our heads out into our shells and put our investments into safer, lower yield, lower risk. It says type your answer. We're going to just give the answer out loud.
Yeah.
And you want to go first, Adam?
Yeah, and I think given it kind of ties maybe into the chart too, considering we talked about things maybe like cash on the sidelines or shoring up assets. Generally speaking, yeah, risk management is important, but we don't want to be overly conservative just due to the market alone. It has to be tied to the particular financial situation of each client and family. And so that's a conversation with have the advisor. We can run scenarios analysis to figure out like, we don't want to take on more risk than absolutely necessary. If we can meet your goals at a lower level of risk, we want to do that. At the same time, there may be some necessary, risk taking to make sure that we're growing assets and keeping up with and exceeding inflation, being able to meet goals because risk is part of the equation. Now we want to take what we think are compensated and intelligent risks, but most have to take some element of risk in the long term. Same thing as we touched on before. Markets can run a lot longer than anyone ever expects. In 2018, for example, a lot of people, if you look back at past headlines, are already talking about how the market was looking awfully expensive, and we've still continued to run. Same thing here, this chart to go through these next two really fast. Also just showing not to get led astray maybe by data and headlines and taking things at face value. There's been some talk, maybe if there's more cash on the sidelines, that could be a catalyst for another leg up. In reality, face value makes sense, but more cash on the sideline really is a function of there just being larger asset balances out there. When we look at sort of the percentage of assets in cash, generally speaking, it's been pretty consistent across the board. Where you see a spike often is in response to a market decline because the market falls in value, cash balances stay relatively stable, and so it seems like there's a higher proportion of cash. Here, this was just saying, again, kind of the same thing. When stocks pull back, that's often when you start to see a spike in cash. Unfortunately, though, you won't really know that you've hit that peak until after the fact in many cases. And so, again, just a quick sidebar to make sure that we aren't led astray by things you may hear in the media that maybe aren't fully interpreted the correct way.
Well, and I would add to that as well, speaking of WDYWFY, that's an acronym, by the way, and it stands for What Do You Want for Yourself? And this speaks a little bit to what Adam just said. A lot of it has to do with what you want for yourself, and there's no need to take extra risk beyond what you want for yourself. However, for you who said that you were long in the tooth, you have already survived a lot of the mortality tables, and people are living a lot longer than they have anticipated. both of my parents are deceased, but my mother-in-law is 95 and is still living at her own home. She does have a daughter who lives there with her. And we continue to maintain balance, which gets back to that concept of smart money philosophy. If the market goes up, we want to be in it to participate because things are going to go up along with it. But if it goes down and you need money, you're going to be fine. There's cash, and the team will have that set as well. So both things will be true. And this notion of being clear on what you want for yourself is, and being clear with your advisor and with us, those of you who are clients of ours, those of you who aren't yet clients of ours, there's still an opportunity for you. So there's room. But that said, we look at it this way. We need to know you. We need to know you, the client, what you care about, what your values are. We need to know your situation. What are the facts? And then we can share with you then your options. And then you can, if you want, say, given that you know me and given that you know my situation and you know my options, what do you think the best one is? That's our job. And we're here to act in your interest. And so I like this. Anything you want to add to that? I love the acronym. This, by the way, is something we use here at the Mather Group. It's a tool that I was given and was developed by a guy named Roy Gear, who passed away a few years ago. But it's a great tool, and we use it actively at the Mather Group and my other companies. Thanks. Anything you would add to this, Adam?
No, I think it's a great summary. And so maybe moving towards the actual kind of summary, tying this all up again,
Yeah,
very, very
timing is
big
taking us there.
on sentiment this month. And so just as again a reminder, we got to monitor it, but where things get a little bit more interesting from one perspective, maybe more precarious from another, is when sentiment is at extremes. It's the old adage, be greedy when others are fearful, fearful when others are greedy. This chart really speaks to that in our view, where JP Morgan puts a great one out every quarter. And it just shows when confidence, sentiment readings are hitting, say, abnormally low levels, historically that's been possibly more of a contrarian indicator, showing that there could be more upside. Conversely, when everybody's feeling really good, that good times are never going to end, that's when you might want to start to be a little bit more concerned. Next chart also, and I think it's our last chart with data. Again, similar story. We looked at, there's percentage bullish investors, bearish, neutral. Here we settled on really looking at the bearish lens, given if you're not bearish, you're probably generally optimistic. The main takeaway we can see from it, at least over this time period, is not that the level of bearishness is going to tell you what's going to happen next. It's more so telling you what's happened. And so looking at the January sort of 25 period here where there was a bit of a downturn, people got scared, they got bearish. They started telling us we're not feeling good about the market because the market's been falling. Once you hit maybe sort of a sustained bearish level, that's when it might be a little bit more interesting because bad times don't last forever. Same thing, the market recovers, people start to feel better because they tell you they're feeling better. If that persists for an abnormally long time or very few people are feeling bearish, then it's probably time to be on guard a little bit more than normal.
You,
And so,
you, you just gave me an idea, Adam. One of the things we might want to throw into one of these charts in the future, there's this psychology of investing that goes along with this that actually labels how one feels at these different
yep,
moments and
flip
this
emotions.
and how one might behave. And over time, this speaks to why when investors who aren't watching this show are actually buying and selling on the news of the day, why over time investments will do better than investors. Because the news of the day will frequently lead the investor to make the wrong decision that day. And
Yep.
that takes us to key takeaways.
Yeah.
So
So Yeah, to summarize, I think it kind of comes back to, emotions are important. It's really important to acknowledge those emotions because that can affect how people respond, how they're interpreting the data. And all of us have to look inward and also try to figure out, like, well, why am I feeling the way I'm feeling? Is that leading me astray or not? So taking a minute, pausing, I know we've talked about this before, thinking about it is good before reacting. It's the reactions have big impacts on markets, especially over short-term periods. And so that can help shape the cycle. And as advisors, those who work with real life people, like we have to understand human nature, and we're human as well. And again, sentiment was a big topic for today. We have to be aware of why people are feeling a certain way, how they're feeling, and is that going to affect the market or not? But it's really those extreme periods where it is more impactful. And so,
Well, this has been great, Adam. I thank you. And I know we're a minute or two long. Our sponsor is going to hurt. Well, hey, wait, we are our own
right,
sponsor. We're all right. We'll cover it. So thank you all for being with us. And by the way, please encourage anybody that you know to tune in. We're building a larger audience. It's getting bigger every month, thanks to you. So thanks for coming back. And for those of you who are here the first time, thanks for being here and please come back. See you next month.
yeah, thank you.